How to invest in REITs. What is a REIT? A REIT is another name for a tax-advantaged company, the company that invests in real estate. REITs are supposed to invest at least 75% of their assets in real estate, must and derive minimum of 75% of the gross income they get from rents, or can be interesting, that is charged on mortgages for real estate. When you build equity or a fixed income portfolio, real estate investment trusts or REITs may catch your eye in consideration. They offer greater diversification, potentially higher total returns, and lower overall risk. To be precise, they generate dividend income along with capital appreciation, and because of that they are said to be a really good counterbalance to whether stocks, bonds, or cash. In general, REITs own and manage a commercial real estate that is income producing. They can be the properties themselves or can be the mortgages on those properties too. You can invest in the companies individually by an exchange-traded fund or with a mutual fund. Any investors who are looking for growth and cash income may find it the right choice as a long-term solution. How do REITs make money? There are two basic ways by which REITs make money. 1. It makes money by investing. 2. It makes money by managing property and doing mortgages financing for real estate. Two basic broad REITs types. Equity REITs. They own a stake in the real asset in a direct way, manage it, collect rents regularly, maintain the property like a traditional landlord. Mortgage REITs. They own mortgages on the real asset, collect interest, collect other payments on the financing of that property. REITs typically borrow a high amount of money to buy their properties, the same as any typical homeowner, but as it has consistent cash flow coming from rents or other payments, it allows them to borrow substantial amounts safely. Types of REITs in detail. Retail REITs. REIT investments are in freestanding retails and shopping malls with approximately 24%. Most of the shopping center is likely owned by a REIT. When thinking about an investment in retail real estate, it's first important to observe the retail industry itself. Examine its financial health at present and the outlook for the future. It's essential to keep in mind that retail REITs make earning from the rent they charge the tenants. If the sales are poor and thus retailers are experiencing problems in cash flow, it may be possible that they may delay or default on those monthly payments, ultimately being forced into bankruptcy. At that situation, a new tenant is important to be found, and finding a new tenant isn't easy. So, you must invest in those REITs that have the strongest anchor tenants possible. These includes grocery and home improvement stores. Residential REITs. These REITs own and operate multi-family rental apartment buildings, manufactured housing. Before looking to invest in these REITs, it's important to consider several factors, such as in each market specifically. Investors are supposed to look for population and job growth. When vacancy rates falling and is coupled with rising rents, it shows a sign that demand is improving. Till the apartment supply in a specific market remains low and demand keeps rising, residential REITs are likely to do well, as it's common among all companies that do best are those that have strongest balance sheets and that have most available capital. Healthcare REITs. Healthcare REITs invest in the real estate of hospitals, medical centers, nursing facilities, retirement homes. Its success is tied to the healthcare system. What you should look for in a healthcare REIT includes diversified group of customers and investments in several different property types. Office REITs. These REITs invest in office buildings. They get rental income from tenants who usually signed long-term leases. Mortgage REITs. REIT investments are in mortgages about 10% approximately. Ways to invest in REIT. 1. Private REITs. Private REITs are not exchange trading. They are not registered. For that reason, they don't disclose the high level of information to investors that any public company would do. These REITs are usually only sold to institutional investors such as large pension funds and accredited investors. Risk. As private REITs are very illiquid most of the time, it may be difficult to assess your money when you need it. 2. Non-traded REITs. Non-traded REITs, just like publicly traded companies, are registered with the SEC. Similar to private REITs, they don't trade on major exchanges. Risk. Non-traded REITs can charge high management fees. They are externally managed. Non-traded REITs are often very illiquid and it's hard to get your money back. 3. Publicly traded REIT stocks. This REIT is registered with the SEC. It trades publicly on major stock exchanges. It offers the public investors the best chance to profit on individual investments. Publicly traded REITs are known to be superior to private and non-traded REITs. It is for reason public companies generally offer management costs that are affordable and better corporate governance. Risk. Just like any individual stock, the publicly traded REIT stocks can decline too. 4. Publicly traded REIT funds. A publicly traded REIT fund offers additional safety. These funds comprise all subsectors of REIT such as residential, commercial, lodging, towers and more. Benefits of investing in REIT: offers diversification as REITs own a multi-property portfolio that has branched out tenant pools, and thus it decreases the risk of relying on a single property or tenant. Affordability: as an investor of REITs can enjoy being a part of a pool of capital, and it is possible to invest in REITs in small chunks. Offers liquidity: as unlike shares, investing in real estate and the purchase and sell is easy real estate investment. High yield: in the time of dynamic economic activity, REIT stocks reflect the appreciation in the value of the real estate. Conclusion: REITs can be a pretty attractive investment. They have a strong track record of performance and many other characteristics just as we mentioned above, such as it has high dividend yields that is derived from the legal order to pay out income, and they are supported by compatible cash flows from the rental property. There are no management headaches, and it also offers property diversification. Few things to watch out may include: 1. Must pay careful attention to the company's debt load to be certain that it's sustainable. Investors must make sure that the company they invest can manage it and pay out its dividend. 2. Investors must look at the prices of real estate through which the value of the REIT is comprised, specifically in a red-hot market. That's all for today. Are you planning on investing in REITs? Comment down below. Don't forget to like and subscribe for more videos.